Today, we're taking the entire barbell system and moving it into retirement. I've shown you the back test, I've showed you the rules, and I've shown you 3 real money accounts using the strategy on the accumulation side. Now we're going to see what happens when the portfolio has to do a different job. This one has to stay invested, produce a monthly paycheck, protect against major drawdowns, and keep enough growth working to last through retirement. We're starting with $1 million, building the entire portfolio on screen, and following it from this point forward. Every withdrawal, every bond payment, every market update, and every annual rebalance. So before we place the first trade, let me introduce you to Captain Cole. Captain Cole is a fictional retiree I created so we can follow a retirement portfolio from day one. This is a model portfolio because I'm not retired yet and I'm not drawing income from any of my own accounts. But I am showing 3 real money barbell portfolios on this channel that I trade through Fidelity with roughly $400,000 to $500,000 invested on the accumulation side. Those accounts show what that strategy looks like while the money is still growing. Captain Cole lets us take the same system and show the other side of it. What happens when the portfolio has to produce a monthly paycheck? In real life, a retiree may also have Social Security, a pension, rental income, cash savings, or other investments helping fund retirement. Captain Cole may have some of those things too, but we're not going to model them here. This series is focused on the barbell portfolio itself, how much income it can support, how the paycheck changes over time, and how the account holds up through different markets. I'm also simplifying everything into one tax-deferred account. Most people won't actually have all of their retirement money in one place. They may have a traditional IRA or 401k, a Roth account, and a brokerage account on the side. My own finances are split that way too, and eventually there are tax decisions around Roth conversions, withdrawals, and which account to spend from first. That can get complicated very quickly, so for Captain Cole, I'm putting everything into one account so we can focus on the mechanics of the strategy. Everyone's tax situation will be different, but the way the portfolio is built, how it funds withdrawals, and how it gets rebalanced are the parts that apply broadly. Captain Cole starts with $1 million, a 6% annual withdrawal rate, and a starting high water mark of $1 million. That gives him a $5,000 paycheck on the very first of every month. The rules behind Captain Cole's portfolio come from the 2 playlists on the channel, and they are linked in the description. The first is the Foundational Flight Plan playlist. That series explains the barbell itself, why I use the S&P 500, what the strategy is designed to do, what the backtests show, and how the annual rebalance works. From there, the retirement rules come from the Glide Path to Retirement playlist. The series covers how much income to take from the portfolio, the guardrails for raising or reducing the paycheck as the market moves, and the kicker strategy for putting more money into the market during a major decline. So if this is your first time on the channel and you have questions about why Captain Cole's portfolio is set up this way, those 2 playlists walk through the entire system in order. Today, we're taking those rules and putting Captain Cole's portfolio to work. Before I place an order, I always like to take a quick look at the weather. I made these trades on Thursday, July 30th, and I'm planning to release this episode on Friday, July 31st. So let's start with what the market looked like when I actually put the portfolio together. The S&P 500 is sitting about 2% below its recent high. There's been some back and forth, but nothing I would call real damage. The NASDAQ is a little bit more interesting. QQQ is down roughly 8.7% from its high. After yesterday's Fed meeting and the sell-off that followed, it closed into correction territory. Today, it opened higher and moved back out of it, but you can see that this part of the market has definitely taken more of a hit. Now let's pull up the VIX. It's sitting right around 18, which tells me that despite all the noise, there still isn't a tremendous amount of fear priced into the market. Once the VIX starts pushing above 25, that's where I would say we've left smooth air and started picking up some real turbulence. That matters less for the contracts I'm buying today than it would for short-dated options. These leaps still have more than 2 years left on them, so a brief spike in volatility usually doesn't move them the same way it moves an option that expires next week or next month. Now let's go over to USTreasuryYieldCurve.com and look at that rate picture because this is what determines which bond fund I'm going to use. All right, let's start here on the left. CPI is running at 3.5% year over year. PPI is at 5.5%. And down below, we can see what the market is expecting from the next Fed meeting. Right now, it's pricing about an 83% chance of a rate hike in September. That does get my attention, but it doesn't automatically change anything. We still need to look at the 2 rules. First, look at the curve itself. As we move from the short end toward the longer maturities, yields generally rise. That's a normal upward sloping yield curve. Now let's go directly to the U.S. Treasury website and verify the exact numbers. On July 30th, the 3-month Treasury closed at 3.82% and the 10-year closed at 4.68%. The 10-year is paying more than the 3 months, so the curve is normal. That answers Rule 1. A normal curve means intermediate Treasuries, which for this portfolio means IEF. Rule 2 looks for a rate shock. My rule says that if I'm holding IEF and the Fed raises rates by 100 basis points or more inside a 90-day period, I move to the short end and wait it out. A normal Fed hike is 25 basis points. So even if the market is right about another hike in September, that still isn't anywhere close to my 100 basis point trigger. So both signals remain quiet, the curve is normal, and there hasn't been a major rate shock. And the rules still say IEF. And that means I'm building this portfolio today with the NASDAQ coming off a correction, inflation running hot, and the market expecting another Fed hike. That may feel uncomfortable, but this is exactly why the rules exist. I don't change the plan just because the headlines are loud. Now let's build the portfolio. 2 decisions get made before a single order goes in, and once they're made, the trade is just arithmetic. The first is allocation. Captain Cole runs an 80-20 barbell. That's 80% treasuries, 20% long-dated call options. On $1 million, that's $800,000 to the bond side and $200,000 to the option side. That ratio is the conservative end of the dial for retirement, and across the back test, it's the one with the smoothest ride. The second decision is which contract. I'm aiming for a strike about 10% in the money, and I want the furthest out expiration available. SPY is trading right around $740. 10% in the money means I take that price and multiply it by 0.9. So $740 times 0.9 is $666. So I want to strike as close to $666 as this chain will give me, and scrolling down, the closest one is $665. Now the expiration. I want the furthest out contract available, and in this chain, that's December 15th, 2028, which is 869 days away. That's the one. Here's the quote on that 665 call. The bid is $170 and the ask is $173.5. That's a $3.50 spread, which is wide, and we're coming back to that in a minute. Halfway between them is 171.75. So one contract controls 100 shares, so that the midpoint, one contract runs about $17,175. 200,000 divided by 17,175 gives me 11.6 contracts. So I have to decide whether I want 11 or 12. Now, 10% of the money is the target, but it isn't a hard line. The back test showed that anywhere from at the money to 20% of the money worked well. So I have some room to move the strike up or down and try to make the allocation fit the $200,000 as cleanly as possible. I can also mix strikes. I could buy most of the contracts at 665 and use one contract at a nearby strike to fine-tune the total. In this case, though, 12 of the 665 calls gets me very close. It puts me a little over at $207,000, but it's close enough that I'd rather keep the position simple than add another strike just to hit the number exactly. So the order goes in. Buy 12 SPY December 15, 2028, 665 calls with a limit price of $173. I'm being a little aggressive with the price here because this is a paper trading account and simulated fills aren't the same as a real execution. In a real account, I'd probably start closer to the midpoint and give the order a few minutes to work. The order fills at 172.5, which is actually 50 cents better than my limit. 12 contracts at 172.5 times 100 shares per contract brings the total cost to $207,000. Now over to the positions tab. There it is. 12 contracts, SPY 665 call, December 2028, filled at 172.5. Now look at the profit and loss column, down $1,476. I have owned this position for about 30 seconds and it's already showing a loss. Nothing happened, SPY didn't move against me, so what is that number? Go back to the spread. The bid was 170 and the ask was 173.5. I paid 172.5 up near the ask because I wanted the fill. But the platform doesn't mark your position at what you paid for it. It marks it at near the middle of the current bid ask, which is sitting right around 171.27. The difference between my fill and that mark is $1.23 a share. Times 100 shares a contract times 12 contracts is $1,476. Now, another broker may show a slightly different number because platforms don't all mark options positions the same way. Some use the midpoint, some may lean on the bid, the last trade, or their own calculated mark. So the number on the screen is an estimate of the position's current value, not necessarily a price where I could close it right now. Growth side is done. Now the other 80%. After that fill, I've got $792,992 left in cash. IEF is the Intermediate Treasury Fund, 7 to 10 year treasuries, and it's trading at $93.23. Look at the spread on this one. Bid 93.23, ask is 93.24, a penny wide. That is the opposite of what we just dealt with on the option side. 792,992 divided by 93.24 is 8,504 shares. Order goes in for 8,504 at 93.24, and I'm filled for a total of $792,912.96. Back to my positions tab, and we'll see that IEF 8,504 shares and our SPY December 2028 665 calls, 12 contracts. All of our money is now invested. The option position won't be touched until the annual rebalance, while the bond side will handle the monthly income and withdrawals. So step back and look at what $1 million just turned into. $792,912 in Treasury bonds, which is 79% of it, and the $207,000 in 12 call options, which is 21%. On the surface, that reads like an extremely conservative portfolio, a retiree with almost 80% of his money in bonds. Now look at the delta on those contracts. Delta is how much the option moves for every dollar SPY moves, and these are showing 0.74, so 74 delta. 12 contracts, 100 shares each times 0.74 is 888 shares of SPY equivalent exposure. At $740 a share, that's about $657,000 worth of the S&P 500 in my account. So therefore, $207,000 bought about $657,000 of market exposure. So this portfolio with 79% of the money sitting in Treasury bonds carries roughly the stock market exposure of a portfolio holding about 2/3 of its money in stocks. That is the entire point of the barbell. And here's the part that makes it work on the way down. Delta is not a fixed setting. If SPY runs from here, that 0.74 climbs toward 1.00, and my exposure grows without me buying a thing. If SPY falls, Delta drops, and my exposure comes off by itself. The position gets less sensitive to the market exactly when the market is going against me. That's convexity, and it's the reason I own these contracts instead of shares. That's also why in my backtest, the 80-20 barbell experienced drawdowns roughly in line with a traditional 60-40 stock and bond portfolio. But when the market moved higher, the barbell captured more of the upside. So it matched the 60-40 stock and bond portfolio on the way down and outperformed it on the way up. And that $790,000 in treasuries isn't just ballast sitting there. It's still working. Captain Cole will collect the monthly distributions as they come in, and this is also the side of the portfolio that funds his monthly paycheck. I don't keep a separate bucket of cash sitting idle for withdrawals. The money stays invested, the bond sleeve produces income, and Captain Cole's paycheck comes out of that side of the portfolio. Here's what happens next with this account. IEF every month pays a monthly distribution, and it'll get tracked on the ledger, and I'll update you when I update the accounts on the channel. On the first of the month, Captain Cole pays himself $5,000, and that comes out of the bond side. I'll be back in October with an update on all 4 accounts, the 3 real money portfolios I've already shown on the channel, plus Captain Cole's retirement portfolio. Before I let you go, 3 quick questions I always get about the bond side. First one, can I skip the rotation and just hold IEF? From 1958 through 2024, my bond rule held intermediate treasuries in 237 out of 268 quarters, which is 88.4% of the time. In 52 of those 67 years, it never moved at all. Nearly all of the shifts to short-term treasuries were concentrated into 2 periods, 1966 through 1981 and 2023 to 2024. So yes, simply holding IEF would have been perfectly reasonable. The rotation may add a couple of percentage points over the very long run, but this is not a strategy that has you constantly moving back and forth. Most quarters, you check the signals and you do nothing. Second one, taxes. This is the real problem with bonds. It's not the capital gains from rotating bonds allocations, which is what concerns most people. It's that the coupon rate, from the bond gets taxed as ordinary income every single year, whether you rotate or you never touch the thing. Treasuries at least escape state or local tax, so it's federal only, which helps some of you if you're in a high tax state. But that ordinary income treatment is the structural cost of holding bonds in a taxable account. All right, third and last question. What about municipal bonds? Munis can absolutely make sense for taxable income. They're generally exempt from federal income tax, and bonds issued in your own state may also avoid state tax. So depending on your own tax bracket, the after-tax yield can be very attractive. But the problem is that's not the job this bond sleeve is doing in my account. Think about 2008. My option side would have been falling with the stock market. At the same time, the economy was weakening, so the Fed was cutting interest rates, and investors were moving into treasuries for safety. As treasury yields fall, the value of the intermediate treasury bonds rose. That is what I need from the ballast side of this portfolio. When the option side is getting hit, I want the bond side to have the potential to move in the opposite direction and help offset some of that loss. Municipal bonds don't give me that same relationship. They still carry credit and liquidity risk, so during a financial crisis, they can sell off along with other risk assets. That's exactly what happened during parts of 2008 and again in March 2020. Now, 2022, as we know, was different because inflation was the problem. The Fed was raising rates, so stocks and treasury bonds both fell together. But outside of an inflation-driven sell-off, treasuries are generally the cleaner counterweight for the structure. Munis may be excellent tax-efficient income investments. They just aren't the ballast I want behind the option side of this portfolio. Captain Cole's portfolio is now part of the rotation. I've shown you the 3 real money barbell accounts, the SPY barbell, the QQQ barbell, and the smaller QQQM barbell. Each one gets its own quarterly update, and the headline event in each video is the annual rebalance. The SPY barbell, which is my first officer account, comes up in October. The QQQ barbell comes up in January, which is my captain account. And the QQQM barbell is my cadet account that comes up in April for rebalance. Captain Cole will join this rotation as well, with his first rebalance coming in July 2027. In between those rebalances, I'll still show you how every account is performing, what the market is doing, and anything that matters to the strategy. With Captain Cole, I also walk you through the ledger, the monthly withdrawals, the bond income, and how the balance changes over time. And I think that's where this series is going to be most useful. These portfolios can look complicated when you first see the options, the bond sleeves, the delta, and the rebalancing rules. But once the account is built, it moves incredibly slow. Most of the time, there is really nothing to do. You let the positions work, collect the bond income, take the monthly paycheck, and come back once a year to rebalance. And that's the whole idea behind the system. Build it carefully, follow the rules, and then get out of the way. So let me hear from you. What questions do you have about this portfolio? What would you like to see me cover here on the channel as I go forward? Put it in the comments and tell me what would actually help you, because that's what shapes what I build next. If this helped the barbell make a little more sense today, hit that like button and subscribe if you want to follow all 4 accounts in a rules-based, no hype way of investing. Stay disciplined, stay patient, and I'll see you on the next flight.